Hi guys, welcome to my channel. When you buy a stock, who exactly are you buying from? Many beginners admit there is one yen marketplace where every buyer and seller meet face to face. But modern financial markets are not all organized the same way. Some securities trade on centralized exchanges like the New York Stock Exchange or Toronto Stock Exchange. Others trade through a global network of dealers who negotiate price electronically. So why do some markets need a physical exchange while others operate through dealer networks? And why does this difference matter for investors? Today we will break down the two major structures of secondary market: exchange market and over-the-counter market. Previously, we learned that secondary markets allow investors to trade securities after they have already been issued. Now the next question is, how are these markets organized? There are two major structures. The first is organized exchange. The second is an over-the-counter market, often called an OTC market. The difference is mainly about where and how trading happens. Think about two different shopping experiences. An exchange is like a large shopping mall. Everyone comes to the same locations. Prices are visible. Buyer and seller interact in a centralized environment. An OTC market is more like a network of independent stores. There are no single physical locations. Instead, different dealers hold inventory and communicate electronically to buy and sell securities. Both systems have the same purpose, to connect buyers and sellers, but they organize that process differently. So let's start with organized exchange. An organized exchange is a centralized marketplace where buyer and seller or the brokers come together to trade securities. The key idea is everyone trades through the same system. This creates several advantages. First, price becomes transparent. Everyone can see the current market price. Second, trading rules are standardized. There are clear procedures for buying, selling, and setting transactions. Third, liquidity improves. Because many buyers and sellers are concentrated in one place, it becomes so easy to find someone willing to trade. A good example is the Toronto Stock Exchange. Company lists the share there and investors trade those shares through a centralized platform. Another example is the Montreal Exchange, which specializes in derivatives such as options and future products. The exchange creates an organized environment where market participants can trade efficiently. Now let's look at the second structure, the over-the-counter market. Unlike an exchange, an OTC market does not have one central trading location. Instead, trading happens through a network of dealers. These dealers hold inventories of securities and stand ready to buy or sell at world price. Think about a currency exchange counter. You walk in and ask, how much will you pay for my euros? The dealer gives you a price. If you accept, the transactions happen. That is similar to how OTC market works. Dealers provide liquidity by being willing to trade when investors want to buy or sell. They take the opposite side of transactions. Modern OTC markets are highly connected through computers. Dealers constantly communicate price with each other, so even though there is no central exchange, competitions keep price relatively efficient. Now let's compare the two structures. An exchange is generally based on an order-driven system. Buyers and sellers submit orders, the market matches them. An OTC market is generally based on dealer relationships. Dealers both price and provide liquidity. Neither system is automatically better. The best structure depends on characteristics of the securities. Stocks from large companies often trade efficiently on exchange because there are many buyers and sellers. A company like Apple has millions of investors. A centralized exchange works extremely well, but many bonds trade differently. The bond market contains thousands of different securities. Each bond may have different maturity date, interest rates, credit risk, and issuers. A dealer network can sometimes handle this complexity more efficiently. This is why many government and corporate bond markets operate OTC. From an investor perspective, market structure matters because it affects three important things: liquidity, trading costs, and price discovery. Liquidity means how easily you can buy or sell an asset without significantly affecting its price. Highly liquid markets usually have many participants, narrow bid-ask spreads, and faster executions. Large stock exchanges often provide strong liquidity because thousands of investors trade the same security. OTC market depend heavily on dealers. If dealers are willing to trade, liquidity can be excellent. But if dealers withdraw during stressful period, liquidity can decline quickly. This became especially important during financial crisis, when some markets experience difficulty trading certain securities. OTC markets are especially important in several major financial areas. First, government bonds. Many government securities are traded through dealer networks. Second, foreign exchange market. The global currency market is one of the largest OTC markets in the world. When banks trade currency, they typically do so through electronic dealer networks rather than a centralized exchange. Third, money market instruments such as negotiable certificates of deposits and overnight funds. These instruments are often traded between financial institutions. The common theme is that these markets involve large institutional participants and specialized securities. Thanks for watching.